Gary Wagner from thegoldforecast.com is back once again to give us his analysis on short-term gold. And wearing that aloha shirt, will precious metals be getting some aloha, aka some love? This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Aloha, Gary. Welcome back to Metal Money. How are you doing?
I'm doing excellent. How about yourself today?
I'm doing fine. I thought I'd join you with the aloha shirt here.
That is great.
Gary, per your work, an observation that you noticed was that when gold hit its high back in 2011, we then saw a 5-year decline and then a 5-year ascent up to a new record high. Are we or could we be back in this same cycle again where after hitting an all-time high, gold may be descending for 5 years and then perhaps ascending for 5 years?
Well, it is an observation that I have been looking at over the last couple of weeks. And it is not so much based on the fact that you go to an all-time record high and then come down for an extended period. It is what took gold and silver during that particular time point, in this case with gold and silver, the middle of 2011, up to a record high at that point. In gold, it was 1920. Silver also matched an all-time high at around 50. And the key distinction between that particular point in time and current scenarios is that we had the unique situation in which the Federal Reserve was faced with a recession. They were caused by completely different things from the banking crisis and the pandemic. But what is similar is that on both occasions, the Federal Reserve initiated rounds of quantitative easing, meaning they accumulated huge amounts of bonds, in the case of most recently U.S. debt, as well as mortgage-backed securities, to add liquidity to the market. First, it was to temper the recession itself, and then it was to assist in aiding the economic resurgence or recovery that followed. And so what I was looking at is we saw quantitative easing back in about 2009 through 2010, and around the middle of 2011, they began to wind down. Of course, they had QE 1, 2, 3, and 4, and the last two, one of them was called Operation Twist, in which they didn't buy anything, but rather kind of swapped long-term for short-term debt instruments. And it was interesting to look at that period of time, what drove the market higher, which was absolutely the devaluing of the dollar at that point and action by the Federal Reserve, and then how it reacted as the Federal Reserve kind of took its foot off the gas pedal. One of the interesting aspects that I didn't talk about in my report on last Friday is that U.S. equities and gold were running basically in parallel to the upside. One of those rare occasions when you see two asset classes that typically run as a negative correlative. In other words, if one goes up, the other tends to go down. These both running in tandem to the upside. And what happened that I found interesting that isn't occurring yet now, if it will, I don't know, but we saw equities continue their rally and gold begin to sell off. Now, in terms of my observation, this is simply a model by looking at what occurred on the only other occasion that we have seen that kind of action by the Federal Reserve and what possibly could be reoccurring on this occasion. Now, the Fed has not begun to taper. They've announced that they'll taper soon. It could be as early as November. It could be sometime next year. It's all going to be data dependent. But there is something that is unique in both time cycles or times, in that the Fed had an unusual action of flooding the market with liquidity through quantitative easing, and then they let off the gas. So I'm looking at what happened when they let off the gas back in 2011, 12, and 13, and what could possibly happen once they begin to taper, whether it's November or next year. So that was the observation I was trying to make and the model that I created from that.
And sticking with that, it's simply an observation. If this happens again, where we go through a 5 year descent, for all intents and purposes, with a 5 year descent of lower gold prices coming off of an all time high, would one simply conclude that the bull market may have ended?
Well, we could certainly say that the highs achieved in August of 2020 are going to remain the record highs for quite some time. There's one thing you need to note, and that is that even as the market has come down off of those highs, it is still trading at a relatively high value when you compare it to what occurred as the market ran even in 2000, where it ran to $1,000 at 2008, and then came down to 700, and then ran to the record high. We are still looking at significantly high prices for both gold and silver. So whereas we might have seen a top in the market, it doesn't necessarily mean that these recent prices, meaning between 1680 on the low and say 1800 on the high, that we won't see it remain range bound for a couple of years between those two price points. Because one thing that we noted when the market dropped in the middle of 2011, it dropped, but then for about a year and a half or 2 years, it traded between 1537 and 1800, hitting those tops and bottoms on numerous occasions. So whereas we saw the value hold back then before it dropped, we could easily see that occur again.
Gary, you mentioned that 1680 price point. Why does 1670, 1680, why does it seem to be such an important support level for gold in recent years, and notably even a double bottom that we recently saw?
Well, if we look back at that particular price point historically, we had the double bottom that occurred in March of this year. It also matches to the bottom that was hit as during the flash crash, which occurred in August of this year, and it was representing the really robust July jobs report that came out. I remember just shy of 1 million new jobs were added in July. Now, if you go back historically to the prior year, there's a lot of activity at that price point in which the market would come down, test that area, and then move back off of it. It didn't have a significant move off of it at that time, but we have historical data in which we can see that price point being an important price point on numerous occasions, either acting as resistance or support. In this particular instance, mostly support, because when you get that double bottom in March and then you get the flash crash that goes exactly to that point and bounces off of that very, very quickly, it tells you that that's the price point in which many market participants believe that it is a favorable price to enter the market, and they begin to buy gold, and that is, of course, what pushes it higher.
Earlier, you mentioned how there was a correlation between gold and equities back in the 2008 financial crisis. And today, we're seeing a correlation between gold and silver starting to break down a little. We're seeing the silver to gold ratio starting to go up again past 80. Have you noticed an observation or anything where a correlation with gold and silver is starting to break down?
Very good question. Absolutely. Over the last couple of months, we've noticed kind of a decoupling of the standard positive correlation between gold and silver. Historically, when gold moved higher, silver moved higher along with it. In fact, typically, silver would outperform in terms of a percentage gain, the rallies, and it would have a larger percentage drawdown during periods of price decline. Now, over the last couple of weeks, specifically, we have noticed days where gold would go up and silver would go down, or silver would go down and gold would go up. And I think what we were witnessing is the return of the safe haven asset class being gold, and silver reacting more to the needs of the industrial composite of the precious white metal because it is so highly used in industry, whereas gold is typically not. And so that decoupling, I believe, is that silver became more sensitive to ebbs and flows in U.S. equities, and especially the talk about Biden's infrastructure bill, and his clean energy bill, which would require a massive utilization of solar panels and solar power, and that, of course, requires silver to build those panels. And so I think the decoupling we're witnessing is that gold has become more sensitive as a safe haven, and silver has become more sensitive in terms of the industrial applications for that metal. Because silver is a precious metal, but it is a highly used industrial metal. The same cannot be said for gold.
Yeah, it's a great point there. You touched on the government here. Debt ceiling is still an issue. How do you see this debt ceiling crisis being played out, and what will it mean for gold?
That's interesting. We had the powers that be, the House and the Senate, last week pass a resolution to keep the government funded until middle of December. And I'm glad to say I now know the senators and congressmen and women will get paid, because I was concerned about that. So in other words, they're funding the government for payroll. It also includes Social Security and other integral components of the aid that is given to senior citizens and those that are sick. However, the debt limit or ceiling, which is currently set at 28.4 trillion, ties the hands of Secretary of the Treasury Janet Yellen, because even if they allocate more funds to the government to allow her to pay bills without raising the debt ceiling, she still can't pay those bills. Now, we have had this happen on multiple occasions, more occasions than I would have ever thought possible through the Obama and Trump era. But in each and every occasion, some struck as an 11th hour deal, so to speak, they have always raised the debt ceiling. I firmly believe that if something isn't reached in the interim, it will be a 12th hour decision, because the repercussions of them not raising the debt ceiling are profound. And I don't think anyone will let that happen.
Gary, in the short term, what numbers are you seeing for gold and for silver?
Well, what we're looking at now is that we were in a defined downtrend in both precious metals very recently for a period of time that kind of subsided last Thursday. We saw a tremendous move in gold gaining about $34. We saw a 4% increase in the rise of an ounce of silver on Thursday of last week. And so for the last 3 consecutive days, meaning Thursday, Friday, trading today, we're looking at Monday, October the 4th, we've seen that market move up. The first areas of resistance that I'm plotting with silver are higher than in gold. Gold is getting close to a 38.2% Fibonacci retracement area, and that sits at around 73. That could be, on a technical basis, an area we want to look for some sort of pullback. In silver, it comes much further in terms of percentages from where current pricing is. It doesn't really come in till about $24 per ounce. That's the first level of real major resistance in silver. So if we see a continuation of the rally that began 3 days ago, those are the areas that I would look at to see if it breaks through that area and moves to the next target of resistance, or whether it backs off. Regardless of what we see gold and silver do in the short term, for those purchasing physical gold and silver, I know, at least for my investment purposes, I look at these investments as not a speculative play, but a long-term play, a hedge against inflation and the devaluation of currencies across the board. And I believe wholeheartedly that whatever gold or silver does over this next 6 months, 5 or 10 years from now, you can look back and believe that those prices were low when compared to what they will be.
Gary Wagner from thegoldforecast.com. We appreciate the time you've given. Aloha and mahalo, and I hope we can do this again soon.
I certainly would look forward to it. Thanks so much for taking the time.
That was Gary Wagner from thegoldforecast.com offering up his outlook and observations for precious metals. As always, please leave your thoughts in the comment section below and remember to keep it liquid, keep it real. And I'll see you on the next episode of Metal Money.